Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to Walmart here. The company came out with numbers kind of in line. I thought they were pretty good numbers, but the guidance definitely disappointed the street. We've got the stock off 6.4% here today, but still up about 66% year to date. Remember, this has got a market cap of $781 billion, does Walmart. So let's check in on this story. Emily Cohn joins us, Bloomberg Consumer Team Leader, joins us here in our Bloomberg Interactive Broker Studio. Emily, what kind of jumped out at you for this earnings report from Walmart?
Thanks, Paul. Yeah, definitely the lower than expected profit forecast for the full year. I think these were consistent estimates. This was a consistent guidance in line with what they laid out last year for the full year as well. But it definitely signaled that the world's largest retailer, Walmart, isn't immune to the risks that are out there for the broader economic environment. Granted, Walmart has historically given conservative outlook to start the year off. But this definitely showed, and they used the word uncertain. I haven't checked, but a number of times on their analyst call. That was sort of like the theme of the call.
What else did they say for this, I guess we could call it, conservative or negative outlook? Did they mention it's because consumers are pulling back, people are looking for bargains? I guess, what did we learn about the consumer in this report?
Yeah, it wasn't negative. It was in line with what they offered last year, 3 to 4% growth. But I think, I think that's taking into account near-term investments. So they mentioned things like consumer trends and near-term investments, like the cost of the acquisition of the smart TV maker Vizio. We're still seeing those costs take a hit on the bottom line. But yeah, they said they haven't incorporated yet the risk of tariffs into their guidance. We also saw U.S. retail sales dip in January and core inflation pick up. So I think those are all things that are weighing on retailers, and Walmart certainly isn't immune.
How about on the tariff front? I mean, I'm looking at the Bloomberg News right up here. Talk about tariffs. Walmart imports food from Mexico and general merchandise products like microwaves from China. What are they saying about tariffs? Is that incorporated in their guidance?
They said they have not incorporated tariffs into their guidance before. Tariffs aren't new for a company like Walmart. Obviously, we saw import tariffs, during the last Trump administration. But they're doing what we've seen most companies do so far this year, which is say it's uncertain, we're not sure what's going to happen, and we're not incorporating tariffs into our guidance yet. But food prices were up. For them, general merchandising prices, I think, came down a little bit.
I actually learned something new about Walmart today.
Go.
And that's that you can buy a pre-owned Chanel bag through their website. So I guess they're getting into online sales. They're beefing up their digital operation to include items like collectibles and pre-owned Chanel bags.
Wow.
Think about that. I mean, luxury items at a discount retailer.
Yeah, so Walmart is still small compared to Amazon, but in terms of e-commerce, but that's an area where they're just continuing to see huge growth in e-commerce in their marketplace. So that is something that you'll continue to hear them talk a lot about, and there's a ton of upside there. Pharmacy delivery was another one that they shouted out today. That's a new business for them. So these newer businesses continue to grow a lot for Walmart, and they would say there's still a big runway there when it comes to competing with Amazon.
It's interesting. Comparable sales, excluding fuel, rose 4.6% at U.S. Walmart stores open at least a year for the quarter ended January 31st. That's higher than Wall Street had been anticipating. So it doesn't seem like the consumer per se, at least in this quarter, was a problem. The consumer was still spending.
So an interesting thing about the growth this quarter and actually last quarter as well was that growth was mostly coming from higher income households. So households that are earning more than $100,000 a year, not the person you typically think of as your average Walmart shopper. These are like wealthier people who are looking for deals, looking for value. Maybe they're coming to Walmart for groceries as opposed to Whole Foods this quarter because prices on food are so high. So that's really where the growth is still coming from, are wealthier shoppers.
So does that tell you then that the consumer is maybe weaker if these high income people are having to move down the spectrum?
It's possible, and I think, we are looking forward to the rest of the big box results coming this quarter. We're looking at Home Depot, we're looking at Target. I think they will tell us a bigger picture view of how the U.S. consumer is doing. But yes, I have the same question. Where are those shoppers coming from? Who's losing here?
Emily Cohn, thank you so much for joining us. Emily Cohn, she's a consumer team leader for Bloomberg News, joining us live here in our Bloomberg Interactive Broker studio, talking about breaking down those Walmart earnings.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's switch gears here. Talk about this Federal Reserve. We had the Fed minutes yesterday. I did not read them. I never read them. That's why we have people like Mike McKee. We've got Danielle DiMartino Booth joining us here in studio. She's the CEO and Chief Strategist for QI Research. What's our Fed doing here? Our Fed can do, is it safe to say they could do nothing all year and that would be okay?
I really don't think markets are priced for that.
Okay.
In fact, in the last week, if there's anything that we've seen, it's the second rate cut of the year begin to be really priced in. So I wouldn't be surprised if we were to see something around June. And I think what's going to force their hand is the job market.
What did you learn from the minutes?
Not too terribly much. And it's not that they didn't try and present a unified front in the minutes, but when the chair of the FOMC gets up at the podium and swats away the verbiage of the statement, without even reading a single line of the minutes, that there was a lot of controversy, dissent, disagreement in that room. So you're going to see very little when it comes to the minutes. Remember, in 2008, Janet Yellen said, we can use the minutes as another tool in the toolbox to continue to shape the thinking of markets, even though they're theoretically time-stamped, but they're not.
You mentioned the labor market earlier. What is your read of the labor market these days? We had, the initial jobs claims came in just a little bit higher than expected today. But I don't know, any number with a 210, 215, 220 seems like the norm. How do you view the labor market?
So I think right now what we have is a pig in a python. And we've had a very constant stream of layoffs in the private sector. I mean, I need to meet and shake the hand of the person who runs BCY Go, because I don't think they sleep. Because the bankruptcy cycle has, even though it hit a 14-year high in 2024, it's only accelerated. My gosh, we've had almost 4,000 store closings announced, and it's just February 20th so far this year. To give you context, CoStar reported that there were 7,300 closed for all of 2025. So we know that there's a bulge of layoffs moving like a pig through a python, plus public sector job cuts. And that's the big change agent. It was interesting to see that the survey week ended February the 15th. That was what was coincided with what was reported this morning. And yet we saw continuing jobless claims pushing 3 million, not seasonally adjusted. The high for the cycle. If you lose your job, if you have a job, don't lose it. That's what Powell said at the podium. But when you figure that there have been 100,000 job cuts announced in the private sector thus far in February alone, and then you tack on 75,000 who took the buyout, and the fact that they waited until today to start laying off 6,000 people at the IRS, 7,000 Department of Defense. It's going to snowball. And it's going to snowball before the Fed meets. Maybe not in March, because today coincided with the survey week for non-farm payrolls, and obviously a fairly low number. But if we don't see it in the February jobs report, we're going to see it in the March jobs report, and then the Fed will meet again. So I think that's why markets have begun to sniff this out. Like 70% of jobs created in the month of January were either government jobs or related to the government healthcare. So when you begin to take that job creation machine offline, that's been such a massive support, in addition to the fact that we haven't had any private job creation net for 2.5 years, something's going to give.
So when we see then that the officials are saying in the minutes that, they want to keep rates steady, we look at what markets are pricing, maybe only one more rate cut. Is the Fed not aware of this snowballing effect that you see coming in the labor market?
Oh, I think Fed officials are more than aware. They do have a narrative to uphold. They're not allowed to say that they're not allowed to scream fire in a crowded theater. But we know that Fed officials know, because Chair Powell, because Governor Christopher Waller, the closest thing to him speaking himself, his closest confidant on the Federal Open Market Committee, they've recognized that new rents are the way to gauge inflation. They've talked about it on multiple occasions. Apartment List yesterday was out with the highest vacancy rate, 6.85%, which took out the July 2020 high. We've got 735,000 apartments that are still coming out of the construction pipeline, and one apartment REIT after another saying rents are falling. I'm going into all these details because if it's rents that Powell and Waller are falling to gauge inflation, and that's exactly what we're seeing in Truflation, TRU, bond traders introduced me to that metric. It's real time, if you will. It's come down from 3.1% to 2.3% this year, Truflation. We can see what's happening in real time with inflation. And then there's the ... what happens with tariffs, and who on earth knows? But we do know that in 2018, with the first Trump tweet about tariffs, that by the end of 2019, the CPI was actually lower because tariffs slowed growth.
Yep, absolutely. Danielle DiMartino Booth, thank you so much for joining us. Danielle DiMartino Booth, she's the CEO and Chief Strategist, QI Research, joining us live here in our Bloomberg Interactive Broker Studio, one of our absolute go-to voices when it comes to the Federal Reserve and what those folks are doing there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube as well. In the greater New York City area, one of the biggest stories over the past couple of days is congestion pricing. It went into effect earlier in January. It seems to be working. I mean, congestion's down.
Yeah.
My travel time into the city when I come in is less. Revenue's up. I don't know. But the federal government, Donald Trump, put a stop to that, a temporary stop perhaps. And we've got some litigation stemming from Governor Hochul here to maybe keep the congestion pricing going. But it is a big, big deal, certainly here in New York City, but also for some other regions around the country that also have some types of congestion pricing. So everybody's kind of watching to see how this will play out. So we want to get a smart voice on this. Sara Lind joins us, co-executive director of Open Plans, joins us from New York City via Zoom. Sara, kind of where are we today with this congestion pricing? Is it on? Is it off? Where are we?
Well, I think the first really important thing to say is that congestion pricing works and it's good for business. When you have groups like the Partnership for New York and REBNY supporting congestion pricing, they're doing it because they know it's good for business within the zone and in the regional economy as a whole. It's still on. Governor Hochul was very clear yesterday. The cameras are still on. The MTA has already filed suit against the administration's action, and I expect the cameras will be on while that all plays out in court.
What do we know about the presidential administration's rationale for wanting to halt this, and then, I guess, what kind of power they have to actually put this through?
I think rationale is a strong word with many things this administration is doing. This feels very personal frankly. Again, there's not a good business rationale. There's not a good rationale in terms of, this is reducing congestion. This is speeding up bus times. That's good for working New Yorkers. This is already reducing traffic crashes in the zone. It's reducing air pollution. So from every perspective that matters, congestion pricing is working. The administration, Sean Duffy, has made arguments that congestion pricing is bad for working New Yorkers. That's just patently false. Only 4% of working New Yorkers, low-income New Yorkers, drive into the zone. All of the rest of them rely on public transportation that has gotten better already with only a month and a half of congestion pricing and will continue to get better. So that rationale is just false. I think that they think they have the authority, but we really believe they don't. Again, lawsuits will bear this out over the next few months, but federal approval has already been given. The program is already in place.
So folks on the other side of that argument would say, and I live in the great state of New Jersey, and I'll defend that one. It's a tax. It's just another tax on Metro New York people, and boy, aren't we taxed enough. What's the response to that?
Well, it's a toll, and there are toll roads all over New Jersey, for example. This is a common technique that states and municipalities use to raise money, both for highways and for other funding. This is going to the MTA and funding our public transportation system. But Governor Murphy, has been very critical of this. We'd love to see him get rid of all the tolls on the New Jersey roads, if that's his argument.
Okay, and so where are we on the process of how New York is trying to fight back? Just walk us through kind of like what the timeline looks like here.
Yeah, so the MTA immediately filed suit. We knew this was coming. Trump has been talking about this, since the campaign. So the MTA immediately filed suit. I expect that there will be a countersuit from the administration to turn off the cameras, seeking an injunction. I don't know that, but just that would be my assumption. And so then obviously the MTA and Hochul will fight that. My opinion is that an injunction is not warranted here because that would be clear and present damage to the state and the MTA's budget. We should be allowed to continue receiving this funding while the main lawsuit plays out in court. And that can take a long time. Lawsuits famously are not the fastest thing.
So just 30 seconds left, Sarah. In the interim, given that we're now into the legal realm here and the delays, the cameras are on. Are they still recording everybody? Is it still functional?
Yep, the cameras are on. They're still issuing tolls. That will continue until we are told otherwise by a court, and we'll continue to receive all the benefits. And the program has been getting more and more popular over time, as every program in the world that is put in place does. And I think New Yorkers are continuing to see the benefits of this.
All right, Sara Lind, thank you so much. We appreciate that. Sara Lind, Co-Executive Director, Open Plans. Again, congestion pricing, folks, here in New York is a big issue affecting a lot of folks here. Our offices are Lexington Avenue, the Bloomberg offices, Lexington Avenue at 59th Street. So we are just one block inside this zone here. And so for people like John Tucker, Bloomberg News, Michael Barr, Bloomberg News, who drive into the city from New Jersey very early in the morning, 2, 3, 4 o'clock in the morning, it's an issue just for them to their daily commutes. It's an issue for a lot of people. And there's arguments for both sides here. But now it's in the courts.
Yeah, the Bloomberg headquarters actually have cameras, and so Bloomberg News actually has a unique perspective and a unique way to report on this because we can actually see
exactly
right outside the traffic our building, on the street.
Right, and right outside the Bloomingdale's across the street from the Bloomberg headquarters of Bloomingdale's. That's where the cameras are, and they're right over Lexington Avenue, and they've been there for almost a year. So we'll stay on top of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We are live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so now you can actually see us for better or worse. You go over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us here. Earnings coming in. We have about 80% of the S&P 500 companies have reported already. Double-digit increases in earnings per share, a little bit better than expected. Gina Martin Adams from Bloomberg Intelligence was just saying how the numbers are coming in a little bit better than she had been looking for. The question is that enough for this market? Because I don't think the Fed's going to be doing a lot for us this year. That's kind of what the market's telling us. Phil Orlando joins us. He does this stuff for a living. He's a chief equity market strategist and head of client portfolio management at Federates Hermes. We always appreciate getting a few minutes of Phil's time. So, Phil, how did you kind of set the expectations for 2025 with your clients after the really good performance the S&P has had really for the last couple of years?
Absolutely right, Paul. That in 23 and 24, the S&P was up between 20 and 25% total return, and then where we got really aggressive on stocks was what we thought was that oversold bottom in October of 23. The S&P was down around 4,100. And then our year-end target for the S&P last year was 6,200. That was, roughly a 48% rally in stocks over like a 15, 16-month period. That's phenomenal, and it's not replicable. I mean, we're not going to do that this year or next year. But, what we have been telling clients is, in light of the fiscal policy initiatives that we think are going to get put in place over the course of the next 15 months or so, in light of a gradual decline in interest rates that we expect to see out of the Fed over the next year or two, we can still see stocks grind up, mid to upper teens, but not, 20 or 25%. So still a constructive environment, but not as phenomenal as it's been the last couple of years.
Phil, what would have to change, at least for the Fed environment, to kind of dent that view? We were talking earlier about how potentially we might only see one rate cut this year. What if we don't see any at all? How much would that affect your stock outlook?
So we are in the 1 or 2 rate cut camp right now. In the back end of the year, we're thinking the first cut might be September or so, second one, if there is one, December or so, and that's largely a function of the data. Now, remember, Emily, the Federal Reserve has a dual mandate, so they're looking at the trajectory with that Phillips curve trade-off. What's going on with the labor market? What's going on with inflation? And right now, the labor market's pretty strong, and inflation has actually been reaccelerating over the course of the last, 6 to 8 months, based upon whatever metric you want to look at. So given that environment, the market a year ago thought the Fed was going to be cutting interest rates 7 times last year. That obviously didn't happen. And there's a school of thought that the Fed is going to slow down materially, from this year. Remember, they cut their SEP target down to 2 cuts for this year, and the market's thinking, well, maybe it's 1, maybe it's none. And I guess the bears are thinking, well, maybe the Fed's going to turn around and start hiking interest rates at some point. So there's a lot of confusion about, what monetary policy is going to look like. And to some degree, that's going to be driven by what does fiscal policy look like? What is the incoming Trump administration able to get done in terms of extending and making permanent the tax cuts? What are they doing with tariffs? What are they doing with regulations? And how is all of that going to impact economic growth and inflation? I think there's a giant question mark on all of that, yet stocks have been just powering through. We hit, another all-time record high yesterday. So there's a little bit of a disconnect there in terms of the uncertainty in the marketplace, yet the very strong performance of the equity market.
Phil, what is the January Barometer Portfolio Indicator? What is it, and what's it telling you?
The January Barometer Portfolio Indicator is telling us that the sectors of the market, the 11 S&P 500 sectors, in the month of January, historically, the market sort of tips their hand, and the sectors that do well or do poorly in January tend to continue in that direction through the balance of the year. What we saw in January of this year is that a lot of the growth and technology Mag 7 kind of names took it on the chin in the month of January. Investors began to lock in some profits, yet the sectors of the market that we felt had been left for dead the last year or two, financials, healthcare, industrials, utilities. They had a pretty good month, all better than the S&P 500 performance. So what we've been talking about since the middle of last year is that we felt that there would be a reversion to the mean, that the dramatic outperformance of the Mag 7 names would ease to some degree, that there'd be some profit taking and a rotation of some of those profits into the forgotten 493 that had dramatically underperformed, and we thought that there was a significant catch-up trade in the offing, and for the better part of the last couple of quarters, that trade has started to work, and we think it's got legs.
Phil, we don't have a ton of time left, but I want to get your thoughts on the data that we saw showing a slump in retail sales. What does that mean for the equity market?
I wrote a piece beginning of the week that hit the Federated website yesterday. It talked about the consumer slowing down. We had a pretty good Christmas, all right, and we define Christmas as October through January. Christmas sales were up 3.9% year on year this year versus 2.8% last year. So it was a pretty good Christmas. But October, November, December were pretty good. January sort of fell off a cliff. January was not good. And you look at a number of the issues that are happening. We talked about inflation starting to reaccelerate. Consumer confidence has started to roll over. Personal savings rate had come down to a 2-year low. Low-end consumers are struggling. Our view is that the strength we saw in the fourth quarter of last year is going to decidedly slow here in the first quarter. And I guess depending upon what happens with the Fed and Washington, that trend may stabilize in March or April, or it may continue to weaken. We'll just have to see.
Phil, thanks so much for joining us. Always appreciate getting a few minutes of your time. Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management, Federates Hermes, joining us via Zoom. Appreciate getting his thoughts. He's been really clear on his market calls over the last 4, 5, 6 years, and more than not, he has been spot on. So it's a good voice. We like checking in with Phil Orlando.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.